Good morning. New topic then, limited companies. So we've done the accounts of a sole trader. We do partnerships next year. And we have two types of limited company, public limited company and a private limited company. Now the accounts that you can see now, they would either be a public limited company or a private limited company. We don't really make much of a distinction when we study these, although there will be little subtle differences. We don't bother with them. So these are either private limited companies or public limited company accounts. Now those that started on time have had a chance to look at these accounts. I have sent these. Ideally you've printed them out. What I'd like you to do as a quick starter is try and picture the accounts of a sole trader, which should be familiar to you, and compare them with the accounts that you see in front of you. This is a limited company. And once you've identified a number of differences, let's discuss the differences. So I'll give you a couple more minutes on that task. In fact, what would be useful, if in the chat, you can start logging down any differences that you see. Now remember, participation is important, otherwise the lessons are hardly worth doing. Okay, engage. Put down some of the differences you see in the chat, please. Thank you. Okay, good. So we've got Jake has put in tax is included on the income statement. That is a difference. With a sole trader, they don't include tax on the income statement. They have to fill in a self-assessment, and the tax is calculated in a different way. Okay, it's not shown on the income statement. Amy, shares are included. Yeah, lots of information about shares in the capital and reserves, the bottom part of the statement of financial position. So if you're looking at the bottom half of the statement of financial position, what you should notice is it's distinctly different to that of a sole trader's. Okay, first of all, obvious things, it's got a different name. You'll see it called equity or capital and reserves. You might see some other names. And it starts off with shares, share premium, revaluation reserve, retained earnings. All do not look familiar at all. But there are some familiarities. Let me just look through the list of what you've put down. So Jana has said one of them have tax included and the other shares. Yep, and that's summarising what Amy and Jake have said, really good. Angela's picked out a specific thing, revaluation reserve, good. Jake, backup for fluctuations in valuation of assets. Interesting, not sure what that means though, Backup for fluctuations in valuation of assets. Jake, have you swallowed an encyclopedia? What does that mean? Another one for Jake, similarities, non-current assets plus current assets minus current liabilities minus non-current liabilities gives us the final net assets figure. Yep, it works like a statement of financial position, just like a sole trader. Well pointed out, that's important. Okay, very, very similar. That top half is identical. It's identical. You might get elements in the detail of these items which are different. For example, in non-current liabilities, we used to see in a mortgage or a loan, you might get this other thing called a debenture. Okay, other than that, generally the same. What else? I'm still interested to understand what Jake meant by backup for fluctuations in valuation of assets. Amy, can you decipher what Jake is talking about there? Angela, how about you? This is revolutionary. This is a Donald Trump comment. Tremendous. Amy's saying revaluation reserve. So looking at Jake's backup for fluctuations in valuation of assets. Interesting. So Jake, did you mean when non-current assets go up in value, that has some link to the revaluation reserve? Is that what you meant? Aha, absolutely, yeah. Okay, that is true, and let's have a look at that. When your non-current assets go up in value, you may remember when we did concepts and we were talking about the value of a property. And I'll give you an example of somebody who may have opened a shop in Mayfair 60 years ago, bought a property for 50,000 and now it's worth 5 million. Now, what would the double entry be if the company got valuation and they increased the value of the non-current asset? It would change here. Okay, we said it was 50,000 to start off with and it's gone up to 5 million. Let's make it easy figures. Let's imagine it was 1 million at the start and now it's gone up to 12 million. The change is 11 million. Okay, so it's going to go up to 12 million from 1 million. So you can see we've increased that to 12 million there. This is not a precise example, but what would happen is you would debit your non-current assets and you would credit your revaluation reserve. Remember, anything that happens in the top half of the balance sheet or statement of financial position must be reflected somewhere else in the accounts to ensure that the bottom half is equal to the top half. Okay, so going back to Jake's point, when the value of a non-current asset goes up, you'd include that in the revaluation reserve, thereby maintaining the double entry. Non-current assets will be debited, goes up. Revaluation reserve is credited, goes up. Okay, Jake, respect for that. Tremendous. Going back then, looking through the list, I really like Jake's point actually, which I'm going to emphasize again. Jake is saying non-current assets plus current assets minus current liabilities minus non-current liabilities gives you the net assets figure. In other words, this statement of financial position is no different to that of a sole trader. It is identical apart from the bottom half. Okay, good. Let's have a look at the income statement. I want some more comments about the income statement. Maybe Jake, you can jump in and do a similar comment to what you did for the statement of financial position. No additional income. Well, that is your additional income. It's just got a different name. Okay, so we could put additional income. That'd be the same thing. What else? Jake is saying, okay, fine. That means it's pretty much the same. Pretty much the same. Start off with revenue. take off cost of sales, you get your gross profit. That's identical. We just haven't shown the detail of the opening inventory plus purchases minus closing inventory. We haven't done the returns, we haven't done carriage, but they're in there perhaps, hidden, okay? Because very often with a limited company account, what you have is you have one page of summarized accounts, then you have several pages explaining each figure in detail. For example, if this company has regional areas in which it does sales, it might have a page on revenue and it'd be broken down into regional areas. Okay, northeast, north, southeast, southwest, and it break the sales down and it would tell you the returns inwards there. Okay, so a lot more detail in the following pages after the summarized accounts, which generally you don't need to deal with. Okay, you're just going to present this. So revenue, cost of sales, gross profit, identical, add additional income, identical, expenses, identical, lumped together, separate page with all the details. Sometimes, and more often than not actually, you will have to provide a bit of detail on the page. So just like you did before, with the expenses of a sole trader, you'd break them down into heat and light, advertising, sundry, depreciation, blah, blah, blah. Okay, so you will have to do that. We've just lumped them in here. We've lumped them in here. You might find a few different terms. You might say selling, you might see selling expenses, administration expenses, remuneration for directors, so the reward to directors, their salary, their wages, any other things that they've earned. Okay, so you might see a few different terms within the detail for expenses, but generally the same. Finance charges, right, what are finance charges? Now, if you've done your reading, you know exactly what they are. Unless you did your reading whilst you were watching TikToks. What is a finance charge? Excellent, Josh, thank you. It's interest on long-term liabilities. So you would have your non-current liabilities here. You'd have a bank loan, you'd have a mortgage, you would have a debenture. Debenture is a new term for you. We'll deal with that later. Any expenses relating to long-term liabilities, in fact, specifically, not any expenses, specifically the interest on the non-current liabilities would be set separately in finance charges. If it was a sole trader, interest would be in operating expenses. It'd be in that figure there, but not for a limited company. We separate it out. Okay, most companies are financed by debt, by non-current liabilities. People don't want to people don't want to risk their own money necessarily. So very often they turn to banks, they turn to other companies, other institutions, and they raise money and they put them in non-current liabilities. The other way, of course, of raising money or finance or capital, a better term, raising capital would be to issue shares. We'll talk about shares in a minute. Right, then we've got profit. We've got different levels of profit here now. Look, we've got gross profit, which we have in a sole trader. We have profit from operations. That's a new term. Okay, it's just a level of profit. That level of profit is before finance charges. Once we take finance charges off, now that would be good in brackets, wouldn't it? So if you printed this out, you should be annotating this, making notes, highlighting, underlining, whatever. If you haven't, then you'll be struggling to learn. What you might be doing is frantically copying this out, because that's a better way of learning than just looking at this. So some of the notes, some of the things that we've talked about, you should add these in brackets there. I'm not going to put it, I'm not going to mess this up too much. You could put interest on long-term liability. There, where I mentioned operating expenses, you would say same as a sole trader, but also selling expenses, administration expenses, remuneration or director's remuneration. Okay, remuneration is what the directors earn. They are three different terms that you might see. Cost of sales, you might put in brackets very quickly. Opening inventory, so OI plus P, P for purchases, minus CI, closing inventory. Okay, just to suggest that it's exactly the same. Revenue, in this case, what could we add to it? Well, we could have returns inwards. We haven't got it in there, but it might be in the detail in the accounts. Okay, going down to the next level of profit then, after finance charges, we have profit before tax, PBT. Then, of course, we have tax, and then profit after tax. Good. Now, switching over to the statement of financial position, Jake has made it quite clear that the top half is pretty much the same. The only differences are in the details of some of the items that you might find in the 5 categories. I say 5, I mean 4. 1, 2, 3, 4. Remember, net current assets is just a subtotal. Current assets minus current liabilities. Again, be active in making notes. I'm just going to take that off there. I don't want to mess this up, but there you go. Things like that, please be active in doing. You know how it works anyway. Jake is asking, profit before tax is net profit. Yeah, I mean, this is slightly confusing, even with the textbooks. Sometimes they regard profit after tax as net profit, sometimes profit before tax as net profit. Now that becomes very, very important when we calculate ratios. Now, if you've done GCSE business studies, you know what I'm talking about when I mention ratios. We're going to leave it for now, but Jake's point is correct. You could argue that that is net profit. Okay, that's your net profit. But you will see sometimes it's a bit confusing. Business studies textbooks might be slightly different to accounting textbooks when they come out with formulas, but that's for later. But thanks again, Jake, that well pointed out. Very good observation. Amy, can you remove me from this lesson, please, when you have time? I keep getting notifications. Amy, unfortunately, I'm not going to talk about it now, but I'm not able to do that at all. You'll just get the notifications, please ignore them. Okay, sorry, that was Amy Day, not Amy Davidoff. Let's carry on. Right, let's have a look now at the equity capital and reserves. Right, when we set up a sole trader, the first line we normally have is the capital. Okay, in fact, let's just think about the formula that we have for the bottom half of the balance sheet. Can anybody put the formula down, please? What can we do there? Sorry, Amy, sorry about that. Yeah, what can we do there? Sorry, what is the formula for the bottom half of the balance sheet for a sole trader? Starts off with opening capital. What do we add? What do we take? Think about the finance by section on a statement of financial position for a sole trader. Can somebody recall the formula? Now, you've done several statements of financial position, so you should all actually know this. Try not to wait for somebody to do it. Amy, capital, add net profit, less drawings. Perfect. Absolutely right. Okay, now let's compare that to what we have for a limited company. A limited company, in essence, although it looks completely different, actually, essentially, it's the same. The only thing that's missing, the only thing that is different really is drawings. You don't have drawings for a limited company. Now, you're not going to be convinced by that statement when I say this is pretty much the same as a sole trader. How can it be the same? It looks very different. Well, the first 2 lines are your capital. So your ordinary issued shares and your share premium, that is your capital. That's money that's been raised by selling shares, if it's a private limited company, to friends and family. If it's a public limited company, to the general public, financial institutions, other businesses, etc., to anyone. Anyway, the first 2 lines, that is your capital. So that's the same as a sole trader. Okay, revaluation reserve, fair enough. We don't have that for a sole trader. This is unique to a limited company, and that, as we explained before, when the value of a non-current asset goes up, usually premises, a building, then we increase non-current assets, that's your debit, and we credit the revaluation reserve. Remember, you can't restore the balance on a statement of financial position if you change the top half without doing something to the bottom half. So that is specifically for non-current assets. So you are actively making notes and you have written that down. Okay, non-current assets, it's related to non-current assets. I'm going to get rid of that. It's usually to do with buildings, as I said. Retained earnings. Well, Amy reminded us that we add profit and minus drawings. I've mentioned that there aren't any drawings, but there is profit, and that's what the profit is, retained earnings. And that is an accumulation of profits from the day dot. So that's different. It's not the net profit for the year, it is an accumulation of profits from the day dot. In other words, when the inception of the business, when they make profits, they just add them onto this, onto this, onto this. Anything that they've retained, kept hold of. Okay, perfect. Any questions? Any questions? Again, Jake asked a very good question about profit before tax. Is that essentially the same as net profit? And we said, yes, it is, but beware. We'll do more detail on that in a topic in a few weeks' time. Anything else? Please be inquisitive. This is the way to learn. Amy is asking, is shareholders' funds the same as closing capital? Yes, absolutely. Shareholders' funds is the same as closing capital, which of course is the equivalent figure of net assets. Good question. Jake is saying, I suppose so. I suppose, oh, you're answering the question. Well done, Jake. You can take over the teaching. I'll hand over the rights to you. I'll put my feet up and have a coffee. Okay, excellent. Right. Is that it then? No. There is more to it, of course. There's this thing here. Now, if you printed it out, let me just get rid of that. There is another document which you have to prepare for a limited company, which I'm struggling to get on one page. Let's have a look. Right, there you go. This is a statement of changes in equity, fondly known to students as the SOCI. Statement of changes in equity. Interesting, frightening, but is it? Well, this is the equity section, and we're saying this document, it would be on a full page, imagine, is showing the changes in equity. Right, now I want you to be very perceptive here. Now that I've told you that this table represents the changes in equity, can you find any similarities between this and the equity section? Can you find the similarities? Come on, guys. Jake, the end values are the same as the values there. So we're saying the end values are here. End values are here. Let's see if Jake is right. Let's see if we can all see this. All those end values relate to those values. Whoops, I can't highlight them like that. Guys, I want you all to be active in this. I want Jake taking over the world. Right, good. Yes, they are. Brilliant. Amy is saying essentially it's the same as the bottom half of the statement of financial position. It is. What is the difference then? Well, it's showing you what changed from the start of the year. The start of the year, you had these opening figures. Of course, you can't see them there on the statement of financial position because we're just showing the end of this year. If we showed the start figures on the previous statement of financial position, that's what you'd have. Any figures in the middle, let's think of it as a sandwich, these are all the changes that took place during the year. Now, this is a very simple example, but let's just have a quick look. What took place? Right, well, rights issue, what does that mean? It means we sold shares to our existing shareholders. They had the right to buy shares. So we issued some shares, we raised capital. We made profit. We call it profit for the year. We generated profit, not made profit. We generated profit. And can you see that figure on the income statement? Can you see that figure on the income statement? Rhetorical question because I've highlighted it for you. Okay, that's where that figure came from. It's profit after tax that goes in there. So profit for the year, when you do these statement of changes in equity, you will be minded to put PAT, profit after tax, as a reminder for you. Okay, otherwise you might pick up the wrong profit figure. In the question, they do trick you by providing you with more than one profit figure. You have to adjust it, take the tax off. Sometimes they give you the final figure. You need to be vigilant. Okay, what else happened during the year? There's a revaluation. So we started off with a property. Imagine it's a property, usually is. It was worth $500,000. During the year, it was revalued, verified, so it didn't breach any concepts. And now it is worth $1 million. What else took place? Okay, that's interesting. There is an error there actually, but I'm not going to point it out and you don't need to look at it. Ignore it, because this was just an illustration of what's going on here. What else have we got? We've got dividends. So in the column for retained earnings, we had retained earnings at the start of 450. We generated 0.9 million, but then we paid out in dividends. So anything that happened to retained earnings after profit after tax, we would adjust there. We end up with 1.25. Of course, that figure you can see there, retained earnings 1.25 million. And then we add across all the figures, add across, and then add down. And can you do this with your calculators now, please? Can you add across all the figures that are highlighted in yellow in the SOCI table and all the figures going down that are highlighted in pink, and see if they come to the same figure, please? Okay, so you've got your calculators out. You're just ensuring that these figures do tally. Add across, yellow, add down, pink. Does it give you 10.25 million? Thank you, Patrick. Good. Okay, that's sufficient time to do that then. Right, just to reiterate then very quickly, these are the accounts of a limited company. They could represent a private limited company or a public limited company. Essentially, there's not much difference between them. We'll talk about the differences between the two types of company in a second. Left-hand side, you've got your income statement. Right-hand side, statement of financial position. Income statement, pretty much the same up to that point there, 1.9 million. We'd call that net profit at that point. But of course, it's not net profit because you've got your interest charges, which really would have been included for a sole trader in operating expenses. We take them off separately there. Take off the tax, we've got the final profit after tax. Statement of financial position, top half is the same, bottom half has elements that are very similar. In other words, the first two lines are your capital. This is a unique line, revaluation reserve. You never see that in a sole trader's accounts. And you've got your retained earnings. You could imagine that's your plus your net profit. But there aren't any drawings. You're not allowed drawings in a limited company. Okay, not allowed drawings. The directors of the company can take a loan from the company, but they can't willy-nilly take stock or any other asset from the business. Okay, good. Right, let's get to your reading now. Document 371. Right. Now, we're not going to go through this word for word, okay? This is something you can read. I may annotate one or two things here. There's nothing difficult here. Nothing difficult. Any difficult bits I will go over. Okay, introduction, fine. Disadvantages of a sole trader. Well, we've done unlimited liability before. If the business becomes bankrupt, the debts are the owner is liable for the debts, therefore personal possessions are at risk. The amount of capital is limited. That's why in a limited company, the massive advantage is the ability to sell shares, raise money by selling shares. So that's why some sole traders end up being partnerships, some partnerships end up growing in size and then becoming limited companies. Private limited companies, what's the difference? Essentially, the main difference is if you have a public limited company, and these are all your well-known companies, Tesco, Manchester United, Nike, all these companies, you can buy shares in. Anybody can buy shares in, anybody. You and I, the Lloyds Bank, Barclays Bank, you know, companies can buy shares in companies. Anybody can buy shares in a public limited company. That's why they use the word public. That public does not represent public, meaning the government. Okay, not that. Not that. It's just a reference to the fact that anybody can buy shares in this company, the public. So when you do public sector in business studies, public sector refers to the government. This is not the public sector. This is a public limited company. Okay, do not make that mistake. Yeah, the difference is public limited company can sell shares to anybody, any institutions, any individuals, whereas a private limited company can only sell shares to those people they invite. Now, this is a bit baby language when we say friends and family. It's not always friends and family. It's anybody they invite specifically by invitation, really. Okay, by invitation. Now, it could be individuals. It could be another company. We just summarize. We just make it simple and say friends and family. A bit babyish. Okay, you'll see textbooks saying that as well. Right. Now, why would you buy shares? Why would you buy shares? Two reasons. Two main reasons. Somebody might argue there's a third reason as well, and there is, but generally, you and I, if we were buying shares, why would we buy them? It's almost a rhetorical question because the answer's there in front of you, isn't it? One reason is every year you may share the profits with the company. In other words, you would earn a dividend. Okay, you'd earn a dividend. That's one reason. It's a source of income. The other reason is it is an investment for you. You might buy your shares at, let's say, £1.50, and in 3 years' time, if the company is performing well, the value of the shares may have risen to £2.50. At that point, you may decide to sell the shares, and you would make a profit per share of £1. That's known as a capital gain. Now, it doesn't say it there. Can you put capital gain? Let's just have a read where we put it. The shareholders hold the value. Okay, just put something there perhaps for capital gain. So the example of capital gain is the profit that you get if you buy shares at a lower price and sell them at a higher price. The difference is a capital gain. Can you put capital gain somewhere? Okay, and then the other reason, of course, was dividend. Now, hopefully you're highlighting this, you're underlining it, you're emphasizing it, you're logging it down. Okay, active learning, please, active learning. Right, let's just carry on here now. Right, this is unusual. If you haven't done business studies at all before, then this requires a bit of explanation. When you set up a limited company, whether it be private or public, you have directors. Now, imagine you've set up a private limited company. The directors are the owners of the company because they have shares in the company. And because they are the directors, they're on the board of directors, a group of directors, they also control the business. They own it and they control it. They run the business. Over time, if these directors invite more and more people to buy shares as a private limited company, and then perhaps eventually as a public limited company, when they start selling shares to the general public, then over time, actually, their control becomes diluted. At the start, they may have had 100% share ownership. If that share ownership, as they sell more and more shares, falls below 50%, i.e. the majority, they lose control of the business. They are directors, they're part owners, they set up the business, but their baby now is not controlled by them directly. It's controlled by other people that have been appointed to the board of directors. Okay, so this is background. You might have the opportunity in a written question to explain that, not in a lot of detail, because that's more business studies. It is more business studies, but it's important to understand it. Okay, as you sell more and more shares to different individuals, your control, your ownership becomes diluted. We call it diluted. So when you make a cordial like Ribena, you add water to it, it becomes diluted, doesn't it? Initially, it was pure. You had 100% share of that company. But as you've sold more and more shares, you've added more and more water, more and more shareholders, you have less and less control, to the extent that if you lose majority control, then of course, other directors, other shareholders are effectively in control of the business. Okay, as I said, it's more business studies. Now this is important as well. This is again background, it is business studies, but it's interesting and you should have an idea of what it means. Conflicts of interest. Okay, very quickly what we'll say is when a limited company generates profit, the profit can be used for various things. It can either be retained in the business for business growth, or it can be distributed to shareholders. Let's keep it simple and just say there are two alternatives there. You either distribute the profit that you've generated as dividends to shareholders, or you retain the profit in the business for future growth. Now there's a conflict of interest there. Generally, the argument is that shareholders prefer, and this is not always true, Shareholders prefer a dividend, a quick return. They want an annual income. They want the dividends. Whereas usually the directors that started the business, they generally want to plough the profits back into the business for growth. So you have this conflict of interest as to what to do with the profits that have been generated. Okay, so a bit more background there. Not too much detail, let's not get lost. We are interested in the mechanics of the accounts. Sometimes you'll have the opportunity to show off your business skills, your business studies knowledge. So all that's business studies, essentially, but generally not so much. Okay, but certainly if you're one of those students going for an A star, A, and a B, then you should understand that. Key terms. Right, this is something you're going to have to go away and learn. Is there anything that we need to talk about? Just going down there, shareholders funds. Remember what shareholders funds was? It was, and this is where you annotate, please. It was the equity section. And that was also known as capital and reserves. Okay, which is also known as shareholders funds. The bottom half of the balance sheet, and then you've got your definitions for the various things that came up there. Ordinary shares, capital reserves, revenue reserves, long-term liabilities. Now, when we come across these, as and when, we'll discuss them a little bit more. But the main thing to be aware of now is ordinary shares. So shares that are issued. If you want to buy shares in Tesco, you can buy them online. You can buy them through a broker. You can buy them through a bank. You might have a couple of £1,000 that you want to invest. You'd look up the market price of the shares online. Perhaps the market price of Tesco shares are about £15. With your £2,000, imagine the £20 actually. Per share, it's £20. You've got £2,000 you'd like to invest. How many shares can you buy? You've got £2,000 that you'd like to invest in Tesco. You've looked up the current market price of the shares, which is £20. How many shares would you buy in Tesco? Assuming you're spending everything. That's not rhetorical, that's for you to do. So some you can do in your head. 100 shares. Absolutely, thank you. And at the end of the year, you'd be hoping for a return. That return is called a, again, that's not rhetorical. Some of you are mouthing it, saying it. Some of you are desperately trying to type it. Jake, you've slowed down. Thank you, Rahib. It's dividends. And some shareholders may hold out and keep hold of their shares for the long term, hoping that they may, what are they waiting out for? What are the two reasons for buying shares? Generally the two reasons for buying shares. There is a third one, but let's just do the second one. If you keep hold of your shares hoping, yes, you're hoping for the price to go up, therefore you would earn a, or you would achieve a, what's it called? Capital gain. Brilliant. That's it. You'd achieve a capital gain. You bought them for £20. Thanks, Jake. And in future, if the company's doing well, then you could earn a capital gain by selling them at a future date. Okay, you'd have to pay tax on those, of course. Okay, by the way, what is the third reason for buying shares? I said there are two main reasons, and we've said financial reasons. We've said dividends, which is an annual income, and we've said a capital gain when you actually sell them. What's another reason for buying shares? Fantastic, Angela. It's control. It's control, to gain control. Now, your average person, your average small company, your average medium-sized bank, they're not going to gain control over Tesco or Sainsbury's or Manchester United or Nike. They're just going to buy small amounts, small percentages. So their aim is not control. However, for private limited companies, this is often a battle where your original directors, a minimum of 2, have invested in the company, they've built it up, and they have to invite other shareholders into the company because they have limited resources, limited finance, and over time, things happen. They can lose control because they're generating more and more capital, and it's going to sources who might end up with a majority share. Okay, and we can talk about takeovers there, hostile takeovers, but it's business studies. If you guys know that, that's good for you. You know, you might have an opportunity to mention it in the exam, perhaps on a written question, but generally that is business studies. So although it's very interesting, I'm not going to get into that. Okay, hostile takeovers. Somebody's taking over your business because they've managed to buy the majority shares. Slowly, perhaps even behind your back, right? Because it's not you that are necessarily selling the shares. Other shareholders have shares and they may have sold on to other shareholders. All complex, and I'm not making too much sense of it. I don't want to get carried away with it, but that's, you might want to look it up, hostile takeovers. Right, that's ordinary shares. We're okay with that. Capital reserves. Well, capital reserves include 2 things. Now, the example that we saw of the final accounts, it had a share premium and it had a revaluation reserve. Revaluation reserve is, we said, when the value of an asset goes up. Usually it's land and buildings. Share premium, we didn't mention that. I just said it's part of ordinary shares, and essentially it is. Okay, but I'll talk about that in a bit more detail afterwards. But it's really when you issue shares, some of it you record in ordinary shares and some of it you record in a separate line as share premium. Okay, then we have revenue reserves. In the example that we had before, we didn't have, actually, let's add, can we annotate this please? We've got profit and loss there. It would have been better if it said returned earnings. Okay, so the profit that you've generated from your income statement goes to the statement of financial position. We know that. And also sometimes that retained earnings, part of it is put into a separate line, general reserve. Okay, again, we don't need too much details of understanding this. We'll get a general idea when we start doing questions. It's more about the mechanics of it. When figures are given in the question, where do you put them? And you need a brief, not a brief, sort of a vague understanding of what it all means. This is as much as you need. The definitions on this sheet are perfect. Perfect meaning they are sufficient. Not necessarily perfect, they're sufficient though. Okay, long-term liabilities. For a sole trader, we said it's generally just a bank loan or a mortgage. For a limited company, this is the big news. We have debentures. Debentures, you need to learn that. It could come up in a multiple choice question. It is a type of loan, long-term loan to the company that secures against the company's assets. What does that mean? It means if the business is unable to repay the interest on the debenture every year, then the company or the institution, perhaps a bank that issued the debenture, in other words, loaned the money to the company, is able to seize the assets it secured against. So, for example, I want to raise a debenture. In other words, I want to borrow money. Imagine I borrow it from a bank, perhaps another company, but that other company or the bank say, right, we're going to secure it against your building. I say, fine. I start paying off every year. I pay off debenture interest. Remember, that's known as a finance charge. Remember that on the income statement, finance charge. I pay my finance charges, the interest on the debenture, and then 1 year I'm unable to do that. What happens? Well, perhaps my assets are seized. Okay, I no longer control them. The company secured the debenture against my assets. I've lost them. That can happen with a bank loan as well, by the way. That also happens with some bank loans. Anyway, we'll see the subtle differences between a bank loan and a debenture later on. There are a couple more differences. Generally, in your minds, you should be thinking debenture, fancy term for a bank loan. That's almost sufficient to think of it that way. Okay, right. One thing might be useful here. When we have a debenture in the questions, and it might say something like, let's imagine it's £100,000. The information might say kind of like 5%, and then it might say 2030. What might that mean? When they express it like this, what does all that mean? What do you think? Hazard a guess, don't be shy. This is how you learn. What could that possibly mean? Jake is saying 5% is paid off each year in interest. So 5%, £5,000 every year until 230. And in that year, 230, you will pay the capital sum. You'll pay that much off. That's perfect. Okay, we'll say it again. Every year you pay 5% interest on that figure. That 5% every year does not reduce that amount. You still have to pay that whole sum off at the end of the duration of the debenture. And that's when it's redeemed in 2030. So if we're talking 2031 now, in 9 years' time, 9 years worth of interest you'd pay, and you would pay the 100,000. Thank you, Jake. Perfect. Right, loans. Yeah, you know, loans. We know about loans. Very similar the way they work, actually. And then we have a mortgage, specialised loan on buildings and land and buildings. Okay. Now this lesson is very much driven by me. It's not ideal because we can't do any tasks until we really understand this. Okay, we're looking at the income statement. We're looking at an extract of it with a bit more detail. So we are really preparing ourselves for different terms as well. So instead of expenses, in the other question it said operating expenses. Okay, you recall that it said operating expenses, it had one big sum. Now we've broken it down a little bit. And we've called it overheads as well. You might see that. And we've broken it down into 3 different types of expenses: distribution, sales and marketing, administration. You sometimes see that in the accounts of a limited company. Okay, you'd still have depreciation, you'd still have light and heat, you'd have all the other expenses as well. But you might have specific new terms like this, and also directors' remuneration, which it would have been nice if it was there, but it's not. Directors' remuneration, in other words, the directors' salaries, wages, bonuses, anything else that they've earned, specifically declared as a specific figure, because the shareholders are very interested to see how much the directors are getting. Why might that be? Why do you think they show the directors' remuneration separately? Imagine you've got your salaries for all your operatives and your workers and all your managers, but you have a separate line for directors. Why should that be declared to the shareholders? Because the shareholders will be looking at these accounts. Why should that be separately declared? What do you think? I'll give you a clue. Let's see if Amy gets there first. So they don't get unfair amounts. That is perfectly right. That's exactly it. We talked about conflict of interest before, didn't we? Wherever it was. We have this conflict of interest. If the directors are awarding themselves salaries, which they do, then what's to stop them rewarding themselves excessively? Well, one thing would be if it's declared and shown separately, they will be wary that other shareholders are going to see this and perhaps say, hold on a minute, I thought we bought shares because we wanted a dividend in the company, and it seems like you're taking all the profits before we even get to that line. Okay, so it's declared separately. The rest of this, then you should recognise it. Finance costs, we said that was interest charges, remember? Usually it's on long-term liabilities, but in the questions it tends to be on the debenture. They only have a debenture, okay? But if they had a mortgage, that would also be included there, or a long-term loan. Tax, what type of tax is that, guys? What sort of tax is it? There are like 10 different taxes in the world. Which tax is this? Corporation. Corporation. Okay, what does a sole trader pay? Do they pay corporation tax? What do sole traders pay? Any idea? Income tax. Perfect. Okay, perfect. Good, good. Let's go down now. Right, remember that SOCI. Well, this is an example of a SOCI where we're only showing changes in retained earnings, assuming there were no changes in revaluation, there were no shares issued, there's no share premium, there's no revaluation, there's nothing. That would be a SOCI table. Now, generally you don't get that, but in our build-up questions, in our practice questions, you will get that as well. Of course, the first one or two questions that we do, I will talk you through them and do them with you. One or two of you might be able to do them yourselves. But that essentially is a SOCI table where only changes have happened in the retained earnings. Let's just see one figure. Can you identify where any of those figures have come from, linked to the income statement? This is important. There are so many figures there. Where do you get the figures from? There's one figure that you would get from the income statement. Jake is saying profit, but then somebody is saying, but hold on a minute, Jake. We've got gross profit, we've got profit or loss from operations, we've got profit or loss before tax, we've got profit after tax. And we've even got a different name for that now. We've got profit attributable to equity holders. Yeah, it's the final one. That profit after tax or profit attributable to equity holders. Sometimes you might get fancy terminology like that, which is annoying once you've learnt the term profit after tax. You think you've sussed it out. Profit before tax, profit after tax. It's annoying when they come up with another term, profit attributable to equity holders. Okay, that 28, thank you, Jake. That 28, you can see quite clearly is that figure there. So when you learn all this, where it says profit for the year, you might learn it as profit for the year. If you're a stronger student and you're using your initiative, you might say, look, I'm just going to learn it as profit after tax, because that's what it is. If I learn it profit for the year, I might get mixed up. I might pick up profit before tax. I might pick up profit from operations. I might pick up gross profit. Let's be very specific. Okay, even if in the mark schemes it's saying just profit for the year, you will not get penalised if you put profit after tax. Okay, and that way, if you remember it like that, you'll be picking out the right figure. Otherwise, you might get mixed up. And that's what the examiners try to do, of course. Okay, so sum total of those, 41 plus 28 gives you 69. And then dividends. Can you find dividends in the income statement? Can you find dividends in the income statement? Is it something that we put in expenses? Well, you've seen two income statements now. The first one that we looked at and an extract of the second one. Did you see dividends? Perhaps that's too simple a question. Let's call it a rhetorical question. No, you don't see them. Now, it is an important question because if your business studies teacher is using a very old textbook, you will see dividends in the income statements. If your accounting teacher is also using a very old textbook, you would see dividends in the income statement. They are not shown in the income statement anymore. They used to be shown at the bottom. They're not shown anymore. Okay, where are they shown? They're shown in the SOCI table. You have to calculate dividends. Who is going to risk giving me a formula for calculating dividends? I'm putting it on Rahib. Rahib came up with the right answer for the number of shares you would buy if you were spending £2,000 on, was it Sainsbury's or Tesco shares? I can't remember. I think it was Tesco. Tesco shares. If the market value was £20, you said you'd buy 100 shares. How do you work out the dividend on those shares? It's not just on Rahib, it's on anybody. Who decides the dividends? Who decides the dividends? Is it the government? Is it the customers? Is it the directors? Is it the shareholders? Or is it the examiners? What do you think? Directors, perfect. It is the directors, the board of directors will decide. And remember, some of those directors are shareholders. So they're kind of paying themselves in a way, aren't they? Now, if you've got loads, if you've got thousands of shareholders, then it's not such a big deal. If you've only got like 4 or 5 directors, then really, essentially, they're paying themselves, which is fine. It's their business. It's their company. Rahib is saying percentage times the shares yearly. Good idea. They don't express it as a percentage. What they say is pence per share. So it might say 15 pence per share. Now, in our example, it would be 15 pence times by 100 shares, if you can recall that example. Okay, now so it's quite simple actually. They would tell you how much it is, how many pence per share, but the hard thing will be is working out the number of shares. Now that seems quite easy, but you'll see it can get hard. See that later on. Okay, a very theory dense lesson, unfortunately. Very quickly with the definitions then. Overheads, it says, are arranged under 3 types. In brackets, we'll say not always. In the exam, they break it down. So you can put a separate line for depreciation, a separate line for heat and light, if you've got accruals and prepayments. So not always, we'll say that, not always. Finance costs, well, we've already said it's the interest on long-term liabilities. It is separated from other expenses. And it's usually on debentures. Corporation tax, it is a percentage of profit, but it's not as simple as that. So what happens in questions is they just simply give you the amount of corporation tax. You don't have to work it out. But in reality, it is a percentage. Dividends, well, we just discussed that. It is a share of profit. It doesn't say the calculation there, but it's put this down, please. Expressed pence per share. Okay. Expressed as pence per share. Should learn to type, shouldn't I? Okay, and then retained earnings. This is undistributed profit that is kept in the company. Right, let's just see where we've seen retained earnings. In the SOCI table, we've seen it. This was the retained earnings at the start of the period, retained earnings at the end of the period. So we should see that in the statement of financial position. So if you're actively writing notes, you might say, well, why don't I write this down? It's in the SOCI table and statement of financial position. You will not find retained earnings on the income statement. This is important. You won't find that figure, retained earnings. And in fact, this is the proof. If I go back to this here, that 49,000, you cannot see it on the income statement. Yes, you can see the 28,000, which is the profit after tax. Okay, but then it's adjusted. We take off the dividends and we add what was at the start. Okay, so retained earnings, not on the income statement, it's on the SOCI table and statement of financial position. All these things will become very, very important. And this lesson, I suggest you re-watch this. I'm pretty sure I remember to record it. Okay. Now we're running out of time, so we're going to stop there. You are going to reread this document. And of course, you all have read it in the first place. You can see how important it is to print it out. And I know some people can't, which is a real shame. However, we're going to do our best. Read the rest of this document, please, and we'll start at this point on Monday. And on Monday, hopefully, we will get to some questions. Right, any questions before we call it a day? Any questions before we call it a day? Right, it's just for me to take the register then. Good, I've got the register. Thank you for the participation. Again, very good participation. I would say it was dominated by a few students, and I would encourage other students to say the obvious sometimes. If you get it wrong, you get it wrong. You're learning. Okay? You're learning. You're going to make mistakes. All right, guys, let's call it a day. Thank you very much. Bye-bye.